Okay, so still on some basic definitions of life insurance contract, I think this part is very important because we need to understand some definitions, what is contained in a life insurance contract. So the first one is premiums. What is meant by premiums? It is basically the regular amount payable to the life insurance company, which is based on the insured's attained or future age, whether they are smoker or non-smoker, and what is their health condition at the time of policy application. So when a person wish to purchase a life insurance policy, they would need to declare, and give proof of their age. So older people would have to pay a higher premium because the risk of mortality is higher, and they have to declare whether they are smoker or non-smoker. So smoker will have higher premiums to pay. And what is their health conditions? So if they have pre-existing conditions, they have to declare. Okay, you have to declare your health condition at the time when you apply the policy. So upon declaration of all this information, the insurance company will come up with the premium rates that you would need to pay. So the premiums can actually be paid on an annual basis, monthly basis, or it could be, you could choose also quarterly or semi-annual basis. The next one is to understand what is an insured person. Basically, it is the named person whose life is covered in the insurance policy contract. So I think we've already covered the difference between an insured person and the policy holder or the policy owner. It may not be the same person because the policy owner could be the husband, whereas the insured could be the wife. Yeah, so it's not the same person. Death benefit is the amount of insurance money that the beneficiaries will receive from the insurance company upon death of the insured. Okay, the death benefit, okay, the payout amount. Next is the face amount, which is basically the sum assured, which is the amount of insurance cover that the insurer will pay to the insured beneficiaries at the point of the insured's death. Okay, the face amount or the sum assured. How much to be paid under the life insurance policy. And who are the beneficiaries? Beneficiaries are the persons who will receive death benefit proceeds from the insurance company upon death of the insured. So basically, the beneficiaries would need to be named usually on the inception of the policy, but throughout the policy's life, while the policy is still in force, the insured or the policy owner can make changes to the beneficiaries named in the contract. So under Islamic law, the beneficiaries usually would have to be paid out according to Sharia principles or fara'id. In Islamic law, there is certain percentage that certain dependents will get as a beneficiary. So if a Muslim person names the beneficiary in the insurance contract, okay, so here I'm not touching about takaful. Takaful may have other legal implications and so on. So under this an insurance contract, the beneficiaries named, if the person, the policy owner is Muslim, the beneficiary here will only act as the administrator, whereby the beneficiary named or the nominee, okay, we shall call it the nominee under this policy, will have to distribute the proceeds according to Sharia law. Okay, so here we are talking about a Muslim, but for non-Muslim, whoever named in the insurance contract will be able to receive the proceeds, as stipulated in the contract. Okay, a lapsed policy. What is a lapsed policy? It's basically a life insurance policy that would terminate, yeah, upon non-payment of premiums. So after a while, a life insurance policy requires a long-term commitment of paying premiums. So sometimes financial circumstances may change and a person may just choose not to pay anymore. So what happens? Usually the insurance policy will lapse or terminate. However, there are other options that could happen. The first one is that the unpaid premiums will be initially deducted from any available account value. So say that a person pays the insurance policy for 5 years already, and so that life insurance policy, if it has a cash value, yeah, so it doesn't just disappear, it doesn't just go to the insurance company just like that. So upon non-payment of premiums, what the insurance company will do is to take out from the account value, yeah, the cash value, to pay for future premiums. So if someone, say, unintentionally stops to pay premium, the insurance company will automatically take from the account value to pay for the future premiums. However, after a prolonged period of non-payment, for example, more than 1 year, the policy will be converted to an extended term insurance, where the insured will be covered only for death or TPD, total permanent disablement. So we'll have a look at what is this ETI insurance in a while. I think the next slide. And whereby the sum assured and all the accrued benefits on a policy will be terminated by the insurer due to prolonged non-payment of premiums by the payer. So it is very important that the policy holder continues to pay, and it is a commitment, it is a long-term commitment. Yeah. So what is ETI? As mentioned earlier, extended term insurance. An ETI is a policy whereby the insured is only covered for death or TPD like a basic term policy. This is a non-forfeiture option to extend the life of the policy when the policyholder is unable to pay premiums on time. So later we will actually look at the various types of insurance policies. So there's term insurance, there's whole life insurance, and so on and so forth. So extended term insurance is the basic insurance policy with only the death and the TPD coverage, yeah, no critical illness whatsoever, and no cash value. So an extended term insurance can happen if the policy owner stops to pay the premiums. So automatically after 1 year, the policy will be converted into this extended term insurance based on how much premiums that the person already paid. Yeah, was it 5 years or 3 years paying and then they suddenly stop, or is it a longer period of premium payment like 10 years? So it depends on the cash value that is available. Next, we will look at what is cash value. Basically, cash value is the actual accumulated cash value either from dividends or capital appreciation of the units for an investment-linked product, so or an investment-linked policy. We will look and learn later what is an investment-linked policy. Yeah. So in the policy, at time of death of the insured, upon surrender of the policy, or at any given time. So some life insurance policies have a cash value or account value. So where does this cash value come from? Basically, it's from the premiums that you pay to the life insurance company. So how are your premiums broken down into? Okay, so the first portion of your premiums goes to paying your life insurance coverage in force. Okay, so the premiums paid will go into this risk pooling, yeah, where the insurance company will manage your risk. The second proportion of your premiums will go towards paying your insurance company's operating costs. So of course, as a company, the insurance company has its operating costs, it has its marketing costs, and so on. So the premiums that you pay will be allocated into those operating costs, and another portion will be a portion towards this cash value, whereby your money sits and earns interest, yeah, or gets invested. So this is the portion of your money that grows. Next, what is a surrender policy? Basically, a surrender policy is what happens when someone terminates their policy earlier, yeah, before the maturity date. Okay, so the policyholder will terminate or surrender the policy. And what are the reasons for surrendering a life insurance policy? It's basically to maybe to access the cash value, or maybe there's no longer a need for the life insurance policy. Perhaps the person found a better deal with another insurance company, or maybe there could be unexpected expenses in which renders the policyholder not be able to pay for this insurance policy anymore. So a person will choose to surrender the policy, yeah, by choice. So surrender policy, the policyholder needs to give notice to the life insurance company. So this is maybe a bit different from the lapse policy, because under the lapse policy, the non-payment of premium would be unintentional sometimes. So under lapse policy, the policy holder does not give any notice to the company that they wish to terminate. But under a surrender policy, there is clear instructions from the policy holder to the insurance company that they wish to terminate or end the life insurance policy.